All right, so welcome to the Geek Group, Eric. And just to give a brief introduction, I don't have your full bio, but I know about you a little bit over the years. I know that you've been a successful multifamily loan broker, commercial loan broker for quite some time, some number of years. I know that you've also sponsored any number of deals. And so you have sort of a rich background in the whole understanding of syndicating multifamily properties. And so with that, feel free to go in and fill us in on anything that you think I missed. And if you're gonna present, there's a little present button right next to the one with 3 dots down there on the Google Meets.
Perfect. I will do that. Let me hit the present button here and share my screen, if it allows me to.
Right.
I can present, but nothing's happening yet. So, let's see. Any chance you guys? No chance you guys can see my screen. Okay. Is that a no?
No, we don't see. No, we don't see your screen.
Anything yet.
No.
Don't see my screen, but you can hear me, though, right?
Yes.
Yes.
We can hear you.
Yeah. All right. I thought I go to present for the screen share.
Yep, that should be. And
I
anybody
do this.
can present. Yep, and it says present now.
Yeah, it's odd.
And then it allows you to select your whole screen.
For some reason, it doesn't pop up. Turn off the video, close caption. And I apologize, guys. Not so much. Usually not this. Yeah, I'm not sure why it's not. You know, I tell you what, I'm going to continue to try. But in the meantime, if it's all right with you guys, you know, I think one of the things that when I present and talk to folks, one of my primary goals is not to. Can you hear me still? Because it just says my connection was lost. One of my goals is you. Rather than what I think here. So I try to form a skeletal structure, but I really like interacting. As we're kind of have this macro version, I'd like you to dive.
We lost him.
Aubrey, will you text that phone number to me? I'm sorry, I can't see it on my calendar either. And maybe I can text it to him. And it's asking for a PIN number too. Any chance you see a PIN number also?
On the one that you sent, no. Look in the in-call message. Miss Wilder put a message in there as well. Looks like she went to the administrator. He just came back.
I am back. Well, that was a quicker return than before. I think we're getting better. Let's see here. Now I went to the present now, your entire screen. Share, I'm waiting for the option to share my entire screen. Edge wants to share contents of your screen. All right, so it's allowing me to share. Can you guys see my presentation yet?
No.
All right.
Not
yet.
It should be coming up here. It says I'm sharing, so it should be coming up here real soon. It's a blue background, a blue PowerPoint with.
there we go. I see it now.
Coming up.
Okay, great. Now what I'm doing here, I leave this in kind of this mode where we've got these slides on the side because this is a working meeting. This isn't necessarily a formal presentation where it's structured. This is one where I want you to have some dialogue and I want you to jump in and we can dive into topics that you'd like to discuss more. So in an effort to keep it informal, I'm going to leave this mode up. That way we can toggle back and forth between slides and kind of work through this so that when you leave with the information that you want, not the information that I think you need to have, right? And there's always follow-up. So some of you have my phone number, some of you don't. The email address there is a new one. And I still receive emails to the Atlantic Business Capital, but atlantic.ic.com is a new email address that I'm using. So feel free to jot that down. What I'd love to do is just talk a little bit about what I'm going to cover today, and then we'll jump right in. But again, please don't hesitate to raise a hand or just jump in and ask questions, because that's really where we get into the meat and potatoes and where you really benefit. So I'm going to do a high level. We're going to talk about types of lenders that you're typically going to see. We're going to talk about Fannie. We're going to talk about Freddie. We're going to touch on FHA and touch on some CMBS lenders, what those terms are, what their lending requirements are, and then a little bit about how long they take to get done in this current market. Then we'll talk about what they're looking for from you. Talk about the sponsorship qualifications, what a lender sees as a sponsor relative to what you and I might discuss as a sponsor. And then we're going to talk carve-outs, because carve-outs the term can be used in a couple different ways. And I want to make sure that the context is accurate when you're using the phrase carve-outs. Now, I've also put some questions in there in case maybe, things dry up a little bit. I've got some questions that I get quite often that I usually include in my presentation just to kind of keep the juices flowing. So we probably won't need those, but they're there if you need them. So first, let's jump right in. There's some core lenders that you're going to see on a regular basis, and we've always talked about Fannie Mae. We've talked about Freddie Mac. Those are your most desirable multifamily lenders. And I say most desirable because they're the best blend of all the terms, closing timelines, amortization, low rate, it's non-recourse. It's all there in your agency lenders. So those two we're going to talk about. We're also going to touch on CMBS and then a little bit FHA. Now, Fannie Mae, as you know, has two core loan programs. And a lot of times when we talk about rate, when we talk about loan qualifications, we lump all lenders into one category. And it's really important to note that not all lenders are all things to all deals, right? You're going to, based on specific characteristics of your loan request, you may end up with a bridge lender. You may end up with a bank, an actual depository lender, or you might end up with Fannie Mae or Freddie Mac, what we would consider an agency lender. One of the defining characteristics in this industry that you're going to see is loan amount. You're going to find that your loan amount really dictates, number one, what your terms are going to look like. Number two, what lender you're going to go with. So based on where most of you are going, that I know, and forgive me if I'm making some incorrect assumptions, but I've had the good fortune of working with investors that are just coming in to the multifamily space, whether it's from a completely different industry or whether it's from single family or another asset class, folks that are coming into the multifamily space and educating themselves. And I find that you are most competitive in the small balance space, in those loan amounts and those purchase prices that fall between 1 and 6 million, right? That's both Fannie and Freddie have lined out their small balance loan programs where they start at $1 million, and this is loan amount now, this isn't purchase price. They start at $1 million and they go up to approximately 6 million. Now there's some times where they'll go up to 7.5, but that 1 to 6 is that core space. It's a national program, and they're looking for some specifics to qualify for that program. Ideally, they don't want to touch that file very often. So it's built for volume. This program's built for volume, and they've implemented some specific characteristics that the property's going to have to demonstrate in order to qualify for this. One of them is the physical occupancy, and they want that physical occupancy average for the trailing 3 months to be 90%. You've all heard it. You're all familiar with that 90% occupancy for 90 days. One of the things that I wanted to note about that what we call T3, trailing 3 months, is to do a little bit of a deeper dive into how they underwrite their cash flow. And it's a little bit different than how we might underwrite our cash flow, because when you guys look at a deal, you might look at your trailing 12 months and underwrite to that number. You might look at a T6. And right now we look at T6 more often than we had before because of the rent relief payments. You know, you might see a large lump sum payment in 1 month, and you've got to normalize that back. If you just do a T3 and it includes an extra 20,000 that property got in rent relief, that's going to skew your numbers going forward. So we may take that to a T6, we may take it to a T9 to normalize those payments. Your lender, however, is still working off of a T3 rental income number. Now, as far as other income, they typically use a trailing 12 and add that in after, but they will definitively annualize your trailing 3 months of income. Why this is important? Number one, you're working off of historicals. When you do your initial analysis, you want to make sure that for your projections, yes, you project your rent increases going forward. But when you're dialing in permanent debt, especially with Fannie or Freddie, you want to make sure that you're using your historical figures, not your projected numbers. Lenders are not going to give you credit for income that you're not receiving yet. So just make sure you keep that in mind. Your other income is I know you might find it strange where that you know they're going to use a T3 on the rental income, but a T12 on the other. And a lot of times, and I had this on some of my properties, we might receive some of our payments on a quarterly basis. Some of your water might get billed back when the actual bill comes in, and some municipalities only bill quarterly. So to normalize that, they try and just pull the T12, and that's usually what you're going to see is a T3 rental income and a T12 other income. Back to the slides now. General loan terms with these Fannie deals, and this is what you can dial in on these loans. 30-year AM, real standard nationally. 30-year amortization. Your choice of fixed periods. So you can do a quarterly adjustable if you wanted to. They are actually trying to phase that out, but you can do an adjustable. You can do a 5, 7, 10-year term. If you want to, you can even do a 12, 18, or even a 30-year. Those are usually special pricing, but you can do that. So that is there for you. They're non-recourse loans. Nationwide, they are up to 80% loan to value. Now, there's certain markets where they don't go that high, and we'll talk about that in a subsequent slide, but 80% leverage is your standard. But keep in mind, I've been having this conversation a lot lately. Keep in mind that just because the program goes up to 80%, and I know you probably can't see me, but I'm smiling right now, you have to be able to make the payment for that loan amount. So we talk a lot about loan to value. And we'll touch on that a little bit later in the presentation. But look, even though the program allowable LTV may be 80%, always watch your debt service coverage ratio. Always watch what they call a proceeds-driven loan amount, right? What that means is that you will, if the property can only make the payment for a 73% loan to value, that's all you're going to get, right? It's going to be the lesser of 80% or wherever that cash flow will support a 1.25 debt service coverage ratio. I say that just because a lot of times we miss it, and we'll slap in 80%, we'll run our numbers on our projections, but we fail to really dive into the historicals, that T3 rental, that T12 other. We fail to dive into the historicals and look at what our property will actually service. So just a heads up, keep that in mind. Now I'm going to talk about Fannie Mae's program in just a minute. I'm sorry, Freddie Mac's program in just a minute. But what I'd like to discuss now is Fannie Mae's DUS loan program. You've heard the acronym. I'm sure we've discussed it before, but I want to kind of reaffirm how important this is. The Delegated Underwriting and Servicing Program, Delegated Underwriting and Servicing Program for Fannie Mae it's a real institution. I mean, it's a staple in our asset class, because what this does and what Fannie has done is they have given funding authority or approval authority to roughly 25 different lenders, maybe 20, to go out and actually fund deals for you, right? They've been delegated the authority to go out and approve your loan, fund your loan, and then sell it to Fannie Mae after the loan closes. This allows them to make relationship decisions. This allows them to compete with each other with any leeway that they can to try and earn your business. Now, who does it help when somebody's competing for your business? It helps you. It allows that lender to make relationship decisions to try and give you the most attractive loan that they can. Now, this DUS loan program is what we refer to as any loan over $6 million. It's a national program, and these lenders are delegated on leverage, like what loan to value they can lend. They're delegated on the debt service coverage ratio that they can lend up to, the proceeds driven. They're also delegated on their rate. And there's specific borrower requirements that we're going to talk about later that are within their delegated guidelines. In certain markets, and there's various reasons why a market would be outlined like this, but in certain markets, they're referred to as pre-review. And what that means is that DUS lender, that delegated underwriting and servicing lender, is only allowed to fund up to 65% loan to value. And they go by tiers, actually. A tier 3 pre-review is 65%. A tier 4 is only 55%. But typically, there's not very many tier 4s out there. It's just primarily it's T3s at 65%. What has to happen if you want to get greater than 65% loan to value in a pre-review market? That lender has to go in and ask for what's called a waiver. And they do it. We do it quite often. In this market, in the last 18 months, waivers have been few and far between. At some point, they weren't granting any waivers, but they are starting to loosen up a bit and lift some of those restrictions and lend a little bit more freely, especially Fannie Mae, especially in this DUS program, in this $6+ million loan size. Right now, what we're seeing is that Fannie Mae has priced themselves out of the smaller deals. They're not as competitive. And Freddie Mac small balance is a little bit more competitive. Well, I won't say a little bit. They're a lot more competitive in that market. And so that kind of leads me into the next section here. Freddie's program, they also break their programs up into two sections. One is a small balance and one is their conventional program. Now, their small balance also goes from 1 to 6 million. In certain markets, in better markets, they'll go up to 7.5 million. And it's a nice program because they issue a rate sheet on a weekly basis. They send that out to all of their licensed lenders, all of their approved lenders. And when you make application, the rate sheet that was in effect when you make application is the rate sheet that you subsequently close with. What this offers you is certainty of execution. I like it. I personally have a preference for Freddie Mac small balance loans over Fannie Mae for that exact reason. Now, there's a couple other things that I like about it as well, but that certainty of execution where I know what my rate is going to be is extremely valuable to me and my investors, right? We're sitting in a deal and we're processing a deal for 2 months. It usually takes about 60 days to get these loans done. So we're processing a deal for 2 months. You can see some major market moves. right? And just in the last month, we've seen at least a 20 basis point run in the 10-year treasury. We're sitting at 1.45 10-year treasury yield right now. I mean, it's been we've seen a pretty substantial run. Well, if you were already apt on a specific rate sheet last month, they're honoring that rate sheet. And it really provides a nice certainty of execution. So that's one of the things I really like. Now, as far as terms go, the Freddie Small Balance Program is outlined by the market itself, and it's usually the size of the market. So they'll categorize their markets by the top market, which are your real, your large, even beyond your institutional smiles. I mean, they're talking top markets like New York, San Francisco, your major markets across the country. And then a large grouping of cities is your standard market. So it's one below top, your top and standard, and then they go small and very small. So small and very small markets are up to 75% loan to value. Top and standard markets are up to 80% loan to value. Here's some other loan characteristics that I think you're going to find very attractive. The Freddie Small Balance Program will do 30-year AM. They will give you a specified fixed rate period. But what they also do is give you a hybrid, they call it a hybrid program. And what that means is that they'll give you a 20-year term. Your loan is going to be in place for 20 years, and it'll mature. You'll have to pay it off in 20, but your rate is fixed for anywhere from 5, 7, or 10 years. So that means you could do a 5-year fixed and it would float for 15 years. You could do a 7-year fixed and it would float for 13 years, or you could do a 10 and it floats for 10. So you have a lot of flexibility there. What's nice is that your interest only periods, your partial interest only periods are set as well. They're programmatic as well. So if you took a 10-year term, you would get 3 years of interest only payments. If you took a 7-year term, they would do 2 years. 5-year term, they do 1 year. And that's in your top and standard markets. If you're in a small market, you dial that back by 1 year of IO. So it's those types of standardized terms are really nice to have because they're predictable, because they're not going to change up on you. Fannie Mae, their small balance program, it's not quite as standardized. You're not going to lock your interest rate until maybe 3 to 5 days before you close. Their delegated lenders are there to offer you 1 year of interest only payments. If you want to do any more, you've got to go in and ask for an IO waiver, right? When you go in for that waiver, you open the books to Fannie Mae, and you run the risk of them coming back and saying, you know what, we're not really comfortable with this market or this deal or this borrowing team or all of it. We're not going to do any IO, and I think it's best that we stay at 65%. You run the risk of credit coming back and saying that. So it's real important that before you go in for a waiver, you have a heart-to-heart, an open conversation with your loan officer on what the risk is to go in and ask for this. Now, sometimes you can go in and ask for a pricing waiver, shave a couple points off of your rate, and it's no big deal. You don't have to do an open book. You just show them a high-level view of the deal. But if you go in and you ask for an IO waiver and you're asking for a leverage waiver, you want to get up to 75% or 80% loan to value, you open the books and you run the risk of losing even the delegated authority. So always important on a Fannie Mae deal, know what you're risking to go in and ask for that waiver. Just keep that in mind. Just kind of keep that in the back of in the back of your mind. Part of the reasons why I say this, guys, is because when you ask your lender about these items, when they're going in for a waiver, and you talk to your lender and you say, look, let's discuss the risk first. I don't want to lose my 1 year of IO. Is this a skinny deal? Are we running the risk of going in and losing what we have? You're going to set yourself apart from other borrowers. You're going to let that lender know that you understand what their job is. You understand what they're working for and what they're faced with. And that's going to give you a much more solid relationship. it's also going to help you establish that relationship with your broker, because oftentimes you're going through these programs and you're doing a deeper dive into your loan than the brokers ever do. Oftentimes they don't have a clear understanding of these steps that you have to walk through. So you being able to let them know that you understand it will build credibility, and it's going to benefit you in the future. I guarantee that. So that's part of why I wanted to talk about these things. Fannie and Freddie both use that that trailing 3-month underwriting guideline. So keep that in mind as well. It's different than how you look at it as an equity investor. That trailing 3 months is important. Here's another reason why. It takes 60 days to close these things, right? So that means you're going to have new discovery of 2 months during your processing. Well, now that's 66% of your timeline, right? That's 2 new months that they're going to annualize by the time you actually get your commitment. So it's very important that you understand how they're looking at it and understand what is on the horizon, how collections are doing intra-month, so you know what's coming down the pike. So just some helpful hints there as you go through these agency deals. Now let's talk a little bit about CMBS, commercial mortgage-backed securities. This is essentially where your loan is packaged up and sold off to investors, non-agency investors. They're great for Fannie Mae fallout or Freddie Mac fallout, deals that were missed on an agency deal. Still non-recourse, still 30-year amortization in multifamily, as long as it's a multifamily. If it's a commercial deal, they might just go 25 years, but they're still doing 30 on multifamily. They are, however, 75% loan to value, and that's something you definitely want to pay attention to. They're not going to go 80. They will go 75, but that still works in a pre-review market where Fannie Mae might only be 65%. So keep that in mind as well. Loan amounts are typically a minimum of a couple $1 million. They really like to see you over that $2 million mark. There might be some relationships where we can get them done smaller. Maybe it's in a solid market. Maybe it's a repeat borrower. But in general, those are some terms that you can hang on to. $2 million minimum, 75% leverage, 30-year amortization. And they don't offer as much flexibility on their loan terms, right? They typically just do a 5 or a 10-year term. And at the end of that fixed rate period, the loan's matured. You have to pay it off. So just keep that in mind. Now your rate, and this is something that you might want to pay attention to, much like your agency lenders, your interest rate is a function of treasury yields, right? So again, right now that 10-year treasury bond the 10-year treasury yield is at 1.45%. Both Fannie, Freddie, and agency and CMBS lenders price their loans over the 10-year treasury. So, when you watch the 10-year treasury, you see it going up, understand that your rate is going to go up as well. Just another little piece of conversation that you can have with a broker or a lender. Hey, let's just see what that treasury is doing. I always, everybody asks me for that crystal ball question of where rates are going. That it's a great conversation piece, and it's something to keep in mind and always watch on the side of your computer. By the way, the symbol for the 10-year treasury yield is the caret, which is shift 6, and then TNX. And that's if you want to put that in your ticker, you can kind of watch that go through. Now, let me touch on FHA real quick. FHA loans are not the best solution for all loans, but there are certain circumstances where they might be great. So the 223F program is one that you want to be aware of. It's got a lot of positive characteristics. You can borrow up to 85%. You can use it for an acquisition or a refinance. If you're doing a cash out, they're going to dial you back to 80. But what's nice is it is a 35-year amortization. It's fully amortized, no balloons, no fixed periods or maturity at 10 years or 5 years. It's fully amortized at 35 years. Some of the negatives, though, is that it takes a long time to close. It can take up to 6 months to get one of those loans closed. Also, the replacement reserves can be higher. You know, on our deals, how we always underwrite, $250 a door or $300 a door in replacement reserves. If you're doing a 223 deal, an FHA 223 deal, those reserves can be as high as $750, maybe $1,000 a door. If you're buying a property that's older than, say, the mid 80s, late 80s vintage, you might have a hard time getting it through just because of the maintenance requirements. So just some things to consider there. They're very heavy into property maintenance, and that might not be the right fit. But let's consider this. Let's say you're doing a renovation deal. Let's say you have bridge debt for 2 to 3 years and you've sunk a ton of money into the asset. You've got it humming. You've got it, all of your deferred maintenance taken care of. All of your mechanicals are in good shape. And you've got the time to wait for that refi. If it's a legacy investment for you, an FHA 223 might be the perfect fit for that long-term hold. Another characteristic of that FHA loan is that it is true non-recourse. True non-recourse. And by that, it's no personal guarantee, but there's also no carve-outs. Now, we talked about carve-outs right in the beginning of the presentation, and I'll do a deeper dive into that in just a couple slides down. But let me touch real quick. I won't spend a lot of time because I'm getting a little windy in this. Recourse versus non. Oftentimes people, they think, hey, that just means I don't have to put my house up to guarantee for this, to guarantee the loan. They're not going to come and take my house, right? And it's deeper than that. It is that. They are not coming after you personally. But more importantly, or equally as important, is that they're not using your personal income to service the debt. They're not looking at 2 years of your tax returns, doing a global debt to income ratio, and recognizing whether you're efficiently and effectively meeting your personal expenses. And then they look at the property. They're just looking at the property. So your income is fine. I mean, we're commercial real estate investors, right? We never make any money. But that's one of the real great parts of this non-recourse debt. Also, they don't cap you on the number of deals you can do because these loans are securitized and sold off as their own investment. So you're unlimited on the number of loans you can do. And that is a defining characteristic of when you're going to see recourse versus non, right? If securitized lenders, they're typically non-recourse. And we'll talk about kind of who they are in just a second. But if you're going to banks, if you're going to a credit union or somebody like that, in most cases, those loans are going to be recourse. They're going to require a personal guarantee, and they're going to require a full underwrite. So typical non-recourse lenders, like we talked about, Fannie, Freddie, CMBS, FHA. When you're dealing with those lenders, you can expect a non-recourse loan. But if you have to go to a bank, if you have to go to a credit union, or even some bridge lenders, you're most likely going to be recourse. You're going to require a recourse guarantee if you are reasonable leverage. Reasonable leverage meaning above 65%. If you're down to 55, 60%, sometimes they'll do a non-recourse deal for you. But usually above that low leverage, it's going to be a recourse loan. Now, we talked about a term called carve-out, right? One connotation, or one way that the word carve-out is used, is your split, or the general partner's split of the deal. That's your carve-out, right? That's one definition of the word. But also, a carve-out is an exception to the non-recourse guarantee, right? These are certain scenarios or certain events where it would trigger them being able to come after you personally. Most of them are focused around criminal activity, negligence, first payment default, voluntary bankruptcy, things like that, right? They refer to them as bad boy clauses. But it's important to note that these are scenarios where they can come after you personally. Let's say you're doing a solo 401k or something like that, and it's all your money. That could be an issue. That could be considered a taxable event. So it is definitely something that you want to explore and try and structure your strategies the same way. FHA loans, and we were going back to the 223 loan, they do not have carve outs. And that could be a nice feature. Because it's, again, you're not limited when you're doing those retirement. When you're working with those retirement plans. Now, most of your syndications just bringing in IRA money, those are not the key principles. They're not signing on the deal anyway, so it's not an issue. But if it's a scenario where you're investing with your own money and you are the key principal, that's where it becomes a little bit tricky. So talking about borrower qualifications, right? Talking about you coming in, sponsoring your deal, what a lender looks for is from a sponsor. You guys know they look for net worth, they look for liquidity post-closing, and they look at experience. But it's important to know that it's cumulative, right? It's the whole group of sponsors. So we use the term sponsor quite often. We say, hey, what do we need from a sponsor and who's going to sponsor a deal? Well, the reality is, guys, if you bring your key principal team together and somebody has the net worth, somebody has the experience, and you're on that team, you are a sponsor as well. Anybody that signs on that loan is what a lender considers a sponsor. So as long as the cumulative net worth is greater than the loan you're asking for, which again, it includes all your assets. It does include your personal residence. Commercial real estate is obviously the most desirable, but it'll include chattel, miscellaneous items, things like that. They're pretty liberal when it comes to what they include in that net worth. It's cumulative on the whole team. Liquidity, cash or cash equivalents. So your stocks, your investments, non-retirement funds, unless you're of retirement age and you're not going to get penalized. But remember, it's not money that you're putting in the deal. It's money that you're going to have after the deal closes. And right now, everybody's collecting at least 2 months of statements to verify that. The experience, it's changing a little bit. They're asking for more stringent. Freddie Mac especially is asking for more stringent experience requirements, or they'll bump your loan requirements up a little bit. They might add 5 basis points to your debt service coverage ratio. You might want to write this down. They're looking for, if you own one property, they're looking for at least 5 years of ownership. This is Freddie Mac now. And if you own more than 3 properties, they're looking for 2 years of ownership. Just keep that in the back of your mind. It doesn't necessarily have to be looming, all over your desk, but just know that when you're talking to somebody about experience, you want to have those covered, or you might see a slight bump in your debt service coverage ratio. And if you're proceeds driven, that's going to lower your loan amount. So keep that in mind. Now, we talked a second ago about sponsorship triggers and what a sponsor is. If you are a manager of a manager-managed LLC, if your title in that company gives you that control, you're most likely going to have to sign on the loan. Also, if you are over 25% owner, you're at least going to have to get underwritten, meaning they're going to have to pull your credit. You may not have to sign on the loan, but they very, very well may want to pull your credit and just kind of know your client. You fall into the know your client rule. They want to make sure you're not a terrorist, you're not laundering money, that type of thing. So just keep that in mind. Here are some questions that I throw out there. What is a qualified sponsor? They vary depending on whether you're going Freddie Mac, whether you're going CMBS, or this portfolio, this private client group. That can be, those are high net worth individuals that work with different investment firms. Those guys tend to write their own tickets, right? I've seen liquidity requirements up to 20%, net worth anywhere from 100 to 150% of the loan amount. So they kind of cater to whatever their investor tolerances are. But typical agency, Fannie Mae, Freddie Mac, CMBS lenders, those are what as far as the liquidity, as far as the net worth, that type of thing. When we do those larger deals, that's where you might be able to get the exceptions, right? If you're doing a $20 million deal, not everybody's walking around with a $20 million net worth. So if it's a $30 million loan and you show a $20 million net worth or close to it, you should be fine. Remember, we talked about the small balance loans. Those are built for volume. They're a lot less flexible as far as the exceptions that we can get. But on the larger deals, that's where you're going to see greater flexibility. That being said, and I'm going to wrap up here, but just because you get some greater exceptions on the larger deals, this is a word I will leave you with, guys. In this market, do not be afraid to do smaller deals. 1 to 6 million, 1 to 3 million gets you in the game and gets deals closed for you. Don't turn those away as long as you're comfortable with it. I don't want you to do something you're not comfortable with. But I talk to a lot of students who are out there. They're shopping for $30 million deals and they're just getting started. You know, they've got $6-8 million capital raises, which are huge raises. Don't turn away the small ones. The mantra of, hey, let's add an extra 0 or 2. It's great if it works for you. But I tell you what, guys, getting a couple small deals done, getting them under your belt, going through the motions, you will never be sorry you did that. So I want to leave you with that thought: is don't be afraid of smaller deals. Now, I've talked a lot. I want to make sure that I leave some time for questions and touch on anything you want to. I hope I wasn't too redundant with this, but I want to make sure that I at least covered some of these basics. And then if there's anything you guys want to touch on or follow-up questions, I want to make sure I address that. So what do you guys think? Are there any questions out there? Anything you wanted to touch on?
Hey, Eric, I got a question.
Yes, sir.
So what is the occupancy level of these other loans, like the CMBS and the FHA 223? Is it 90% as well?
It's actually lower. And that's a great question, David. I'm glad you asked that. On the 90% physical occupancy is a characteristic of the small balance loan programs, Fannie and Freddie loan programs. When you are working with Fannie's DUS program or Freddie Mac's conventional program, they will allow down to 85% on their occupancy, their physical occupancy. And a typical delta between physical and economic is about 5 to 7%, right? So if you're in that high 70s mark, that's where you're going to have to really tell a story about what's going on with those collections, number one. Number two, they're going to look at the trajectory, right? If you're running in the low 80s and then you dip down to 78 economic, right? They're going to want to know what's going on. But if your trajectory is going up and your first month of that T3 is at 78 and then you're cracking up into the 80s and then you move up from there, that's a story we can tell.
Okay, thanks.
Yes, sir. Any other questions? Anything that I didn't go into clear enough, or you want a little bit of additional clarity on? Might be stuff you already know. Is anybody interested in how these lenders are defining their expenses? And we talked about how they look at their income and how they underwrite the income. Are you guys familiar with how they look at expenses in general? Let's just pick small balance lenders.
Yeah, I think we'd like to hear about that, Eric.
Okay, it's an area that can vary depending on the lender type. So your small balance lenders might be a little bit different than your CMBS lenders and so forth. But let's just focus on small balance for now. They have a few different ways they look at it, right? You, as an investor and an equity investor, you're going to do a deep dive into the actuals, right? You're going to look at where that seller might be leaving some CapEx in the deal, where you can cut and reduce expenses, and you want to find those value points, right? A lender has a couple different ways they look at it. Number one, these agency lenders look at your budget. So historical income and budgeted expenses, which is a really, really nice tool. The way they look at that budget and the way they finalize that budget is in 3 core areas. One is they look at actuals. They want to make sense of actuals. 2, your budgeted expenses. And 3, the appraiser's numbers. So those 3 are material as far as how they define what their expenses are going to be. A 4th one that they do is they pull expenses from their portfolio. So you're buying a property in St. Louis. It's a $3 million loan. They're going to want to make sure that your numbers jive with the appraisers. They're going to look at the seller's numbers, but not put a lot of clout into that. But they're going to look at their own portfolio. They're going to say, hey, we've got 30 deals that are comparable to this one, or 15 deals that are comparable to this one, and they've been reporting their financials every year. Let's take a look and see what they're reporting. And if you're dialing in something that's an R&M number or an admin number that's way out of whack from what they have in their portfolio, we're going to have to do some explaining. We're going to have to go in and kind of rationalize why our numbers are where they are, why our payroll might be different. R&M is a function of historical maintenance schedules and the vintage of the vintage of the asset. But some of these other ones will need to really align, or at least somewhat align, with what they're seeing in their portfolio. So just keep that in mind. It's you have a little flexibility there based on what the actuals are.
Eric. Sorry.
Go ahead.
Thank you, Tarina. Just to dovetail on that topic. So currently, the expenses that we do on R&M, or even the other expenses, we have a standard for it, right? So, for example, our payroll is $1,000 per unit, right? And then the seller has it for $1,500 per unit, or $2,200 per unit. Now we do a deep dive of why those things are. Is that the kind of deep dive that the lenders are expecting? An explanation on those? Because we have the acceptable standard based on MFG has a standard, RE Mentor has a standard. So how do we differentiate those? And do we really know that the standard is the standard according to CMBS or Fannie Mae or Freddie Mac?
I want to make sure that I answer it properly. Your standard is in fact your standard. It's not going to vary that much. That $1,000 a door is solid. It could be $900, it could be $1,200, but that $1,000 a door is just fine, based on the number of units. Obviously, I mean, I've got a 54 unit that I would never dial in $1,000 a door. It's crippling. I actually tried to run it with $1,000 a door, and we didn't make any money for a while till I got rid of the management company. So you're in good shape. I don't think that you need to deviate from your standard, based on the unit count, obviously. But
right.
But yeah, I think you're in good shape there. That's going to fly. There's some historicals that you're using that are not just arbitrary. Everything that Max has done and what Dave's done and what all the other groups have done is a function of experience and practical application.
Mm-hmm.
So I think you're just fine there. Will you have to explain it to a lender? I'm not trying to be funny, but if they ask, right? There's a human element to all this. And if the seller is running $1,700, well, let me give you a live example. $2,200 a door on a property that we're under contract on. $2,200 a door, because they have a lifeguard on the property. They have 2 maintenance guys that have been there for 45 years. I think, you ever see Weekend at Bernie's? Where they just kind of roll around? Okay, one of the maintenance guys it's just like Weekend at Bernie's. He's just there because the owners love him. The owners have owned the property for 47 years, right? It's more like just a family gathering of a property, and they keep these maintenance guys on just because their basis is so low, they're cash flowing like crazy, and it's our lenders looked at that, they chuckled like we did, and we're like, this is ripe. Let's buy this thing. So yeah, you might have to explain it, but it shouldn't be too hard to get everybody to rationalize $1,000 a door.
All right. Well, thank you, Eric.
Yes, ma'am.
Eric, I have a hypothetical for you. Suppose I'm doing some underwriting and want to make sure my numbers are as realistic and even conservative to a certain degree as possible. So when I'm having a conversation with a lender or an underwriter, a mortgage broker, should I use T6 annualized or T3 annualized?
It depends on the conversation. I hate that word. I hate it depends. But I can modify the answer and say the answer will vary based on what scenario you're in.
Okay.
The reality is, if you're talking about debt service coverage ratio and your discussion is centered around how much of a loan that property will bring, then you're going to talk about historical income, because a lender is focused on historical income. If you're discussing equity returns and purchase price, things of that nature, now you may focus on the rent lift and what that income looks like 2 years down the road. So that your question is really centered on the conversation that you're having and who you're speaking to.
Okay.
And you want to know both. You want to know both. Keep in mind that when you're dealing with the capital stack, you're dealing with two different mentalities that coexist together. You're dealing with almost a system of checks and balances. I mean, it is a bit of a yin and yang, because you've got the debt side that's focused on historical capital. They're conservative. They want to see a proven track record of what to expect. And then you've got the equity side. You've got the big game hunters. You've got the folks that are getting in front of the wave and are betting on the future income. Those two mentalities together, they're kind of like sales and credit of a company. If one ever wins the conversation, if one ever wins the argument, the company goes under, right? So it's that balance of debt and equity in this capital stack that makes the deal work.
Okay. So would you recommend, in regards to a deeper dive type of underwriting, to from a historical standpoint for income, maybe doing a T3 annualized or T6 annualized for income, and then for expenses use a T12?
Well, yes. For understand that your lender's going to look at a T3, and if you are looking to get a true picture, you may have to modify that to a T6 if there's some rent relief that has come in, because that's going to skew your T3 number. So if you're like 40,000, 65,000, and then 42,000, well, that middle month is going to throw things off, and you're going to annualize that and be incorrect. So in that scenario, you might take a T6. It depends on, or you might layer those payments back to the appropriate month. Because if it's rent relief, it's going to be applied to a specific month. So there are certain deal specific changes that you have to make to underwrite it properly. Now on the expense side, T12 expenses are always going to be what you gravitate towards.
Right.
But again, you're going to look at how you're going to run the property in addition to how the seller's running the property, because you're looking at how the seller's running it, so you can find your little find your edge, right? If they're running that payroll too high, you buy it on the cap rate on you're buying it at cap rate on their numbers, right? If they're leaving CapEx in there, then use that for your cap rate on their numbers.
Okay.
You're trying to get a better deal that way.
Okay. Thank you.
Yes, ma'am.
Eric, if I could sneak one in here, on our underwriting templates, we have this toggle. We can underwrite loan to value, or we can underwrite loan to cost. And even by toggling that, you can see the IRR change depending on which it is. What's your thoughts on that? Maybe briefly describe what it is as you see it, and what you think should be the underwriting scenarios for using those different situations.
If you are buying a property and utilizing permanent debt, and you do not have a material renovation budget in place, then loan to value is the proper metrics. If you are buying a property and you have a large renovation budget and your plan is to buy it, sink a healthy amount of money into it, raise rents based on those improvements, and then refinance into new debt, then you work off of a loan to cost. Because that first scenario, your purchase price is your cost, essentially. You're not renovating the property to the point where there's a large CapEx budget and it's material difference to your cost. But on these renovation side, the purchase price is only a percentage of your cost. You've got to look at the whole cost basis. So that would be the defining characteristic for me is LTV on a perm deal, just to put it in kind of a shorter slang terms, LTV in a perm deal and LTC on a reno deal.
All right. And then would it be accurate, would you how would you state, like if you had to explain loan to value versus loan to cost to a newer multifamily student, how would you sort of summarize those two? What are they in global terms?
Loan to value can be described as a loan amount relative to your purchase price, to the actual purchase price of the property. And the V, we're solving for variables here, right? So that V would equal the value. Well, is it really the value? It's the purchase price, but I'm getting it way below the appraised value. That can be misleading. Define the value as where that property is trading, the sale price, because that's truly what someone agreed to pay and someone agreed to sell. That would be how you would define what that value is of that property. I think that's the best way to explain it. Just because an appraiser slaps a number on it, in the resi world, yes, you might be able to cash out based on that number. But in the commercial world, the value is what the buyer and the seller agree to trade that property for. Now, on a cost, you've got the buyer and the seller, what they agree to trade it for, but then you've also got your renovation budget on top of that. And that's really what you're spending to get that asset where it needs to be. So that would be my short answer of loan to value versus loan to cost. Maybe not that short.
Yeah. Well, yeah. All right. Thank you for that. Thank you. All right, you guys. Well, we've got about 12 minutes left. We got to do a rate and wrap at the end of the meeting, and we got to end on time. Any last short question for Eric before we go to rate and wrap?
I got one last quick question.
Go ahead.
In regards to
Thanks, David.
COVID reserves. Can you touch on that a little bit? I remember last time I seen you speak, you said they let go of that, but just want to see where things are at right now.
Really glad you asked that. I should have brought it up. So thank you for asking that, David. And I have a question for you too when I'm done. So I want to leave like 30 seconds for that one. COVID reserves, they are lightening up dramatically. Fannie Mae has lifted their COVID reserves altogether. So Fannie is not collecting reserves. Freddie Mac is collecting 6 months of principal and interest payments in top and standard markets on acquisitions above 65%. So if you're buying something in a top or a standard market, and figure that your larger cities, they're at 6 months of principal and interest. If it's a small market and it's maybe a refinance, something like that, they're going to do 12 months. And that's Freddie Mac small balance. Over 6 million,
okay, so
not
like
collected.
a tertiary 12 months?
Yes, sir. Tertiary market would be 12 months.
Okay, thanks.
Yes, sir. Now, I want to ask you, what's your dream car? Because you said you were looking driving it. What's your dream car?
Oh, so today at one of them, it was a 2021 Bentley Flying Spur. So
Nice.
A really nice car to drive. It was fun. Very fast car.
I didn't see it on Facebook. Did it really happen?
Oh, well, I'm sure my wife will probably blast pictures anytime if you go on my Facebook, you always see Happy Queen with David Selvin. So that's my wife.
Nice.
My friends often say, I'll ask you how you're doing, except I looked at your wife's Facebook page.
Nice, man. Nice. Well, the Happy Queen, I guess that means Happy David Sylvan at the bottom. That's what that translates to, right?
Hey, there you go.
All right, you guys. Eric, thank you so much. It's great to have you on. By the way, you guys, he's back on October 22. We have 3 sponsors who will talk to us. So then Eric's going to talk to us as a sponsor for your potential deals. And then he'll lay out what his criterion is for possibly being a sponsor for you on upcoming deals. And we'll have 3 sponsors on that call. That's about a month away in October, and it's on the schedule. So with that, are you guys able to shift back over to the team document there? Scroll down to the rate and wrap. Remember, you're rating the meeting, not the speaker or the internet coverage. Maybe that's the.
Should I stay on for this, or is it gonna crush my ego?
Maybe stay on for it. It's kind of fun. This is straight from the traction book. This is how they end a meeting. And the goal, Eric, is that people don't leave the meeting with something still on their mind. So here's how it works. If people rate the meeting an 8 or 9, they don't need to say anything. But if they rate a 7, it means they want to get something 7 or below. They want to make a statement. They got to explain why. And it allows them to get something off their chest and or, maybe set up a topic for a future where you're like, we can't solve that right now, but let's keep it in mind for a next meeting. Just sort of, how you leave a meeting and you don't get to say your piece and now you're kind of cranky for however long it takes for you to get over that. That's this portion of the meeting here.
That's great. I love that.
And it's straight out of the traction book by Gino Wickman. So we've stolen all our everything good. We've stolen from somebody somewhere. So, all right, everybody got it typed in. Jay, you ready to go? Unmute everyone. Jay, if you're still there, what's your rating? Can't hear you yet.
I don't think he's on the call.
Oh, got it. Okay, so let me read Jay's. Jay's an 8. Aubrey?
I rated it a 9. Thank you very much, Mr. Stewart, for your time.
Karina?
I rated it a 7 for the dial-in feature. But Eric, your presentation was awesome.
Yep, that's my fault. I will work on that, Trina. I apologize for not having that ready to go. Dave?
Same thing as Tarina. I rated it a 7 because of that little laggy at the beginning. I think it would be a great idea to have maybe the dial-in on the notes so that way everybody will have access to it. I mean, at least that's what we do in my Toastmasters. We have different things on the notes. So if somebody gets logged out, you can easily know where to go to click to get on. So I think that would help. But it was a great presentation.
Thank you. I appreciate your suggestion on that, and thank you for the compliment for Eric. Pedro?
9.
Nice. Test? Can't hear you, Tess. Tess has got a 9 in there. I rated a 9. Darnell?
I rated it a 9 as well. A lot of great information.
Nice. Anybody I missed?
Mary?
Okay, you guys.
Oh.
Yeah, Eric doesn't have to. Eric doesn't have to rate a meeting. He's a guest, I guess. I guess. So go ahead.
Charmaine.
Go ahead, Charmaine.
9.
Nice.
Thank you, Eric. I always learn something.
Absolutely. Thank you for listening. I appreciate that.
Yes.
All right. Thank you so much, you guys. Next week is off because some of us are down at the Dallas event for the Lindahl UP. So if you guys are going to be there the night before it starts, I believe it's Thursday night. A lot of times everybody's down in I call it the local watering hole at the hotel there, the hotel bar. So it's a great place to meet people and say hello and try to reconnect. Okay. So if you're on that, look forward to seeing you there. And then if you're not on that, I'll post the list of all the prior calls in case you miss one. You can go back and pick it up then. And then we'll be back the week after. I believe we're having one of our securities attorneys speak to us about the documents you need to set up your private placement. All right. So thank you guys.
Awesome.
All right. Have a good weekend, everyone.
Thank you.
Good
You
night.
guys have a
Bye,
phenomenal
guys.
weekend.
Thank you so much, Eric. Appreciate
Bye,
it.
guys.
Bye.
Thank you. Appreciate it, Max.
Bye, guys. Thank you.